Hello friends, in this video I will explain you futures contract by taking Nifty 50 futures as an example. So this is going to be a little bit lengthy video, so please watch till the end. Let's recap. What is a futures contract? A futures contract is an agreement done through an exchange where two parties agree to buy or sell something in the future at a price that is agreed at the settlement date that is agreed right now. That's simply what is a futures contract. As we know, forwards and futures are very much similar in nature, except that the forwards are entered into by two parties directly or through a broker, but they are direct agreements between two parties to buy or sell something in the future. And these are custom or specific agreements that suit the requirements of both the parties. As opposed to that, futures are the contracts where they are traded to the exchange. So exchange defines all the criteria. We can call them standardized forward contracts. The trade happens through the exchange, the clearing and the settlement also happens through the exchange. So in this respect, these two are different. Also, certain features of forward and futures are different. In case of futures, both the parties have to pay margins to the exchange. The exchange clearing house collects the margin to make sure that both the parties honor their agreement and fulfill whatever is the part of their obligation from time to time. That is fundamentally how markets ensure that there is no impact on the entire system in case one of the parties cannot fulfill their contract. Let's get into Nifty 50 futures. But before that, let's understand the concept of an index. The concept of an index I have explained separately with what are the uses, what is the application, how the index is composed, and what are the limitations of an index. So do watch separate video made for that. Now, what is an index? We can start with taking Consumer Price Index or CPI as an example of an index. Consumer Price Index is published by Government of India and many other governments in different countries. This index is developed by putting together items that citizens consume on a day-to-day basis. These are food items, things like electricity, telephone, entertainment items, so on and so forth. And depending on the level of consumption in the economy, different weightages are attached to all these items. Their prices are tracked and the consumer price index is reported. Same way, wholesale price index tracks the inflation or decrease in the prices of different commodities that are traded in the wholesale markets, that is between business to business. Coming back to futures contracts that we are talking about, typically futures contracts have some of the underlying assets like currencies, commodities, maybe government securities and bonds, and also equities. Nifty 50 is an index which comprises of approximately 50 stocks that are traded on the National Stock Exchange. These stocks are selected by National Stock Exchange based on some criteria. Most of these companies have good deal of transparency in their operations. Likewise, they are heavily traded stocks with lot of liquidity, that is breadth and depth. So these stocks are what we can call darlings of the market, and they comprise of a very large percentage of the overall market capitalization. So looking at the performance of these stocks, we can look at overall the market performance. So indexes are looked at as barometer of performance of the economy. Nifty 50 comprises of 50 such stocks, as I said, across 13 different industries. National Stock Exchange from time to time reviews the composition of this index. They might add one stock to this index while removing another one, and they might change the percentage that is allocated to a particular stock in the index. Now, when the index is set up at some base year, for example, Nifty 50 has been set up in the base year 1995. It is given a specific value. It was given a value of 1000. Today, in May 2023, the value is slightly above 18,000, which means if you had invested 1000 rupees in those specific 50 stocks and distributed that amount as per the weightage in the Nifty 50, today you would have had 18,000 rupees with you if you were to sell those stocks. Of course, during this time frame, some of the stocks are moved in and some of the stocks are moved out. Weightages also would have changed from time to time. So you would have been required to mimic the composition of the index in order to get this return of about 18 times of your investment. The indexes have certain uses. For example, as I said, they are looked at as a barometer of the economy's performance. Secondly, they are also used by the index funds, which fundamentally are a part of what is called a passive investment strategy. So these fund managers simply mimic an index that they have declared, and they distribute the funds received from the investors on those specific indexes as per the weightages assigned to them. And if the market performs well, that index performs well, then the fund will perform well. If the market does not perform well, it reflects in the index, then it will also not perform well. This reduces the cost of investment, allocation, research, etc., and therefore index funds are very much liked by the lot of investors. Now, Nifty 50 by itself contains 50 stocks. National Stock Exchange has other indexes which contain, for example, 100 stocks, so NSE 100, NSE 500. So NSE 500 we can take as a better barometer of the performance of Indian economy because it is more broad-based index. Likewise, BSE has BSE 30, which is called Sensex. It also has BSE 50, BSE 100, BSE 200 and BSE 500. There are also sector-specific indices. For example, there is a Nifty Banks, which tracks some of the select banking stocks, and then from that we can understand how the banking sector is performing. Let's go to National Stock Exchange's website and look at the Nifty 50 and understand some of its features and related terminology. On the screen, we can see that Nifty 50 futures are a part of what is called equity derivatives, because the underlying assets for Nifty 50 are those 50 equities that are listed and traded on the National Stock Exchange. Also, one thing we can observe here is that at given point in time, there are 3 Nifty 50 futures contracts available for buy and sell on the National Stock Exchange. In this example, this snapshot which I have taken in the month of May, there are contracts available which are expiring in May, June and July. These contracts expire on the last Thursday of the month. So May contract will be expiring on last Thursday of May. Likewise, June and July contracts will be expiring on last Thursday of the respective months. When that contract expires, the subsequent month contracts will open up. For example, when the May contract expires, the contracts for the month of August will be listed for trading, that is buying and selling on the National Stock Exchange. Now, these 3 contracts will give you an ability to hedge your risk for 3 months. If you want to buy a subsequent month's contract, that is not possible. You might have to enter into a OTC or over-the-counter contract with someone else outside of the market. Or you can use the feature of rollover that is available through rollover or spread orders on the National Stock Exchange, which I'll describe to you in some time. Now, let's understand some of the terms that are mentioned on this particular page. Here in this case, the instrument types is called index futures. As we know, the underlying for futures could be stocks, currency, bonds or equities. In this case, the underlying is stocks or equities. Therefore, this is called an index future. Now, let's understand some of the terms that are mentioned here on the screen. We have here instrument type, which is mentioned as index futures. Now, underlying for Nifty 50 futures is the Nifty 50 index, which I explained you just now. The other underlines could be, for example, stocks or equities, could be currencies, or could be commodities, or any other type of asset. The symbol for Nifty 50 futures is Nifty. And the expiry dates, as I explained, are 3 months that we can see right now. 3 months futures contracts are active, and each expiring on the last Thursday of the respective month. LTP here indicates the last traded price for that particular futures contract. Remember, this is not the last price for the index. The index is the underlying asset. Futures contract is a different contract developed on those underlying assets. So this LTP is the last traded price of the futures contract and not the last value of the index. Next one that we can see is CHNG or change over previous traded price. That is the change over the latest price at which the index futures contract was traded. And then the same is expressed by a percentage in percentage CHNG, change over the previous traded price. We also see here, volume. That is the volume of contracts of the Nifty futures traded on the National Stock Exchange. And in each of the contract, we have 50 indexes as the underlying. Now, as I mentioned, in the month of May 2023, the approximate value of index is 18,000, which means underlying each standard contract is 50 indexes, which means 18,000 into 50. So when you buy or sell one contract, you are buying or selling an asset worth 9 lakh rupees. And that value is reflected in the value, which is given in INR lakhs. So contracts into last traded price. So if you sell 50 contracts, for example, 9 lakhs into 50, that is 4.5 crores worth of positions you are taking in the market. If you buy or sell only one contract, you are taking a position of 9 lakh rupees approximately. We also see here something called the open interest. Now, as an example, if let's say I buy 150 Nifty futures contracts today morning, and by end of the day, suppose I sell back 50, then my open position at the beginning of the day was 150 long position. At the end of the day, my position is 150 minus 50, which I have sold. So my net open position will be 100 long. Underlying value basically is the Nifty value, because Nifty is the underlying asset for this contract. So underlying value reflects the latest price of the Nifty or the index. As I have explained, last traded price reflects the last traded price of the futures contract, and underlying value is the value of the underlying asset, which is Nifty in this case. So these two are different. These two, however, closely track each other, because the fundamental factors that are impacting the futures contract price as well as the underlying index and the composition, which is the equities in that, are basically same. So these will not be too much divergent from each other at given point in time. Price steps. This is the minimum price with which the price has to either increase or decrease, and in this case it is 5 paisa. Means, for example, if the price was 18,010 rupees and 15 paisa, it has to either go to 18,015 and 20 paisa, 25 paisa, or come down by 5 paisa. You cannot increase or decrease the price when you put in the order by, let's say, 1 paisa or 2 paisa. This is also called, tick size in many cases. The price band that is there for Nifty 50 futures is 10% over the base price. Means the price is not allowed to be increased or decreased beyond 10%. So it has to follow that particular range at a given point in time on the National Stock Exchange. This price band is set up to ensure that there are no wild fluctuations in the market for no reason. For example, there have been instances in various markets across the world where wrong price was punched in and the entire market crashed. So in order to make sure that this doesn't happen, some reasonable price bands are set up for different types of assets on various exchanges. Then we have order type, order book, and order attribute. Order types are of different variety. There is a regular lot order. As I explained, in each lot of Nifty 50 futures, there are 50 underlying indexes, which means, let's say the value of the index is 18,000. By buying or selling one lot, you are dealing with 9 lakh rupees worth of underlying assets. Stop loss order shows that this is the order which is put in by the trader or the investor in order to make sure that he doesn't incur losses beyond a particular limit. For example, if I have bought the Nifty index, I have a long position at 18,000. Now, I don't want to lose more than 100 rupees in my particular trade. So I will put a stop loss order at 7,900, saying that if the price reaches 7,900, automatically this order should get triggered, and then I should square off my position so that I don't incur too much of a loss. This is called stop loss. Then we have immediate or cancel order type. Immediate or cancel order type is also called fill or kill order in the global terminology. What it means is, I send the order to the market. If it doesn't get fulfilled immediately, then the order stands cancelled. The normal orders will be there in the order book of the exchange till the end of the day. So anytime the order is matched, the exchange will execute and it will confirm the order back to me. But fill or kill or immediate order will expire if it is not matched immediately. Then we called a spread order. Now let's say in the month of May, I have a position open through a July contract. That is, let's say I have 100 contracts of July where I have a long position. Now, the August contracts will become available when the May contracts get closed. So, as soon as the August contracts are becoming available, I can put in an order where I'll say I want to close my July contract position and move to the August contract position, as long as the counterparty is giving the price such that my overall spread or the loss in rolling over is not, let's say, greater than 50 rupees. So 18,100 and 18,050, for example. So if I have somebody who is having this kind of a bid and ask, then my order will get executed and matched with that counterparty, so that for rolling over the transaction to the subsequent month, I do not pay more than a particular amount. So this is called a spread order. So I indicate how much spread I am willing to pay in order to roll over my contract to the subsequent month. By using this, you can keep rolling over your contracts, and though 3 months contracts are available, you can actually take position for multiple months. Now let's move to the next screen and let's look at some more information such as cost of carry, etc. I'll explain those as we go through each and every term that is mentioned on the screen. Now here we see an order book, that is the quantity, that is the multiple of contracts that are available at any given point in time in the exchange's order book. We also see here bid and ask price. Now bid price is the price at which somebody is willing to buy from you. So let's say there is a counterparty which is putting in a bid and ask quote saying that I am willing to buy the Nifty 50 futures from you at 18,100, and then the ask price is I am willing to sell to you at, let's say, 18,150. So 50 is the bid ask spread. Bid will always be less than ask, because obviously somebody is going to buy from you at a low price and going to sell to you at a high price. Also the bid quantity is also mentioned. For example, I am willing to buy up to 2000 contracts from you at 18,100, and I am willing to sell up to 2000 contracts to you at 18,100. This is put in so that they don't get a deluge of orders and end up taking too much of a position at a particular price. Because let's say if they get too many buy orders at, let's say, 18,150, that means there's a lot of demand in the market. So then the price will be moved up to, let's say, 18,150 and 18,200. This is how the market process makes sure that through bid and ask and the orders, the price discovery happens for the stocks or futures that are listed on the exchanges. Here we also see total buy and total sell quantity or number of orders, which means this is the quantity that is available for being bought or being sold across all the open orders at that specific point in time. The another data that we see here is the best buy and best sell price. What is the best buy price? If I am looking at buying something, I would like to buy it at the lowest price. So this is the open bid or ask price at which I can buy, and it is the lowest price available in the market. Likewise, we see the best sell price. If I am looking at selling an asset, I'll obviously try to get the maximum price for that. So this is the highest available bid price for that particular asset, in this case Nifty 50 futures contract. Let's say the highest price is 18,200, I'll obviously like to sell at 18,200 and not at a lesser price. So it gives us an indication of what is the best price available at which you can buy or sell Nifty 50 futures contract at that specific point in time. One more item we see here is cost of carry. In this case, the cost of carry is approximately 6%. It is always expressed as a percentage and is on an annualized basis. So what exactly is cost of carry? How it is comprised of? What is the cost of carry for equity, indices? What could be the cost of carry for commodities? I have explained it through a separate video. So I'll just briefly explain it here. If you are taking a position in something like equities or indices, what you need is basically money to back up. If I was to actually buy that many indices and keep with me so that I can fulfill my obligation to you, the one who is buying the contract from me, obviously I'll have to spend that much money to invest, which means there is a cost attached to that money, which is typically what is reflected in the cost of carry. The cost of carry in this case is approximately 6%, which is very close to the treasury bills yield available in the Indian market, which means it is almost the risk-free rate at which we are able to basically enter into a futures contract. That is one more reason why the trading in futures is very much preferred by a lot of people. You are able to mimic as if you are able to borrow the monies at almost the risk-free rate which is only available to Government of India through RBI. This cost of carry in this case is calculated by using some of the data points like what is the last traded price for this particular futures contract, what is the expiry price, and also the time to expiry. Expiry price is also called the settlement price. We also see here traded volume and traded value. So traded volume is basically all the buy and sell contracts that have been executed on the exchange, and the related value is multiplication of those number of contracts by the value at which they have been traded. That is the last traded price, what we see here as an example. Market lot here is mentioned as 50 Nifty futures, which is what I have explained to you earlier. So when you are buying, if it's a standard lot order, it will mean that you are buying 50 underlying assets of Nifty. So let's say it is approximately 18,000 today, you are taking a position of worth of 9 lakh rupees on the National Stock Exchange. What more we see here? What we see here is open interest. Now this open interest is sum total of open interest of all the participants at that given point in time. I have explained to you earlier, for example, if I buy 150 contracts on NSE for Nifty 50 futures in the morning, I have 150 long open position. In the afternoon, if let's say I sell 50 of those contracts, then now I have 100 open position. Like this, the open position is summarized across all the participants, and that is reflected over here. The open position shows you what is the level of interest in the market for this particular contract and which way the sentiment is being reflected. Likewise, we see here the change in the open position from the previous day's open position. So which shows how the open position is changing today, what is the mood of the market today with respect to the particular contract as compared to yesterday. We also see here daily volatility and annualized volatility. Volatility is fundamentally calculated with respect to the average or the mean prices. So if the asset price is let's say 18,000 over last 1 year, and today we see it as let's say 18,700. So that is the difference between mean that is reflected in the calculation of volatility. The most popular measure of volatility calculation in financial markets is standard deviation, and there are some tricks etc. which are done on top of that. On the NSE website, how the volatility is calculated is explained in every detail. So I'll encourage you to go and look at the definition of volatility on NSE. So there is a daily volatility. Today, what is the fluctuation or the risk in the market for that particular asset, and then there is a annualized volatility, with respect to the market price movement of that particular asset over a 1 year period. We also see here settlement price. Now this is the price at which the particular contract will be settled. There is a daily settlement price that is arrived at by the NSE by looking at the last half an hour of trading, the number of contracts bought and sold, and the prices at which they are bought and sold. So that is the daily settlement price. So on the daily settlement price, actually the contract is settled every day. So if I am having something to be received to me, then I get that money credited to my account. If I have to pay something, that money gets debited to my account. If for example, I bought 2 lots of Nifty 50 futures in the morning at 18,000, and the settlement price declared at the end of the day is let's say 18,100, which means I have a long position, so I have profited to the extent of 100 rupees. Now I have bought two standard lot, which means I have 100 underlying NSE indexes, which means 100 into 100 rupees, I'll get 10,000 rupees credit into my account. Likewise, if the price had gone down, settlement price was let's say 17,900, 10,000 rupees would have been debited to my account by NSE. So as we can see, Nifty 50 futures are very much popular because of the breadth, depth, the liquidity and the volume that is available on the exchanges. So and the cost of executing trades is also very less. At any time you can square off your positions. So these are very popular contracts on the National Stock Exchange. I hope with this you have understood the basic terminology with actual example, how the Nifty or the any other futures contracts get traded on the market. I will create another video with equities as an example to explain this to you in more detail. If you like this video, please do click on the like button. Also, please let me know through comments what more you want me to clarify. Thank you very much and cheers.